Today, we're exploring 9 key habits that reveal your unique money personality. While we often stress the importance of financial literacy, understanding money, and making informed decisions, there's another crucial aspect often overlooked: our individual approaches to handling money emotionally. Recognizing your money personality and the factors driving your spending habits can significantly enhance your financial decision-making. It's essential to pinpoint where you stand so you can adjust your actions to align with your long-term financial goals. While people may exhibit traits from various money personality types, many don't neatly fit into just one category. If you're unsure about your money personality, here are some habits that can help you identify where you fall on the spectrum. Let's dive in. Number 8, the indifferent to money. If thoughts about finances rarely occupy your mind and the idea of budgeting unsettles you, you likely fall into this category. In extreme cases, you might view money as inherently negative, believing it shouldn't influence life decisions. Many with this mindset feel a moderate amount of money suffices for happiness, which can be healthy but risky if it leads to financial neglect, such as relying solely on a partner for financial management. If this resonates, it's crucial to proactively manage your finances. Even if you're comfortable financially, tracking expenses, understanding monthly costs, and assessing debt can prevent future financial stress. Number 7, the worrier. Individuals in this category often grapple with persistent anxiety about losing money, regardless of their financial status. They frequently doubt their ability to achieve financial security and often fixate on worst-case scenarios, especially regarding depleting their financial resources. While it's prudent to anticipate challenges and plan ahead, allowing excessive worry to overshadow present happiness isn't financially advantageous. It's beneficial to foster a positive mindset in financial matters and address the underlying causes of financial anxiety, whether through consulting with a financial advisor or seeking guidance from a therapist. Understanding the root of these worries can help mitigate concerns and steer you toward a more balanced approach to financial management. Number 6, the compulsive spender. If you often find yourself spending on unnecessary items, enjoy impulsively treating others, and use shopping as a way to cope with emotional distress, you might fall into this category. Compulsive spenders derive pleasure from spontaneous spending and frequently struggle to adhere to a budget, even when dealing with significant debt. They often indulge in shopping sprees and prioritize immediate gratification over long-term financial stability. While living in the moment can be enjoyable, financial stress can mount if spending isn't managed wisely. Continuous overspending may eventually lead to bankruptcy, especially if expenses consistently exceed income. For those in this category, it's crucial to establish a habit of allocating a portion of earnings towards savings or investments before budgeting for spending. Opting for cash or debit cards instead of credit cards can help prevent overspending and accruing interest. Setting a monthly limit for non-essential expenses and sticking to it is recommended. Additionally, assessing spending patterns to identify areas where costs can be reduced or replaced with more economical choices is beneficial. Above all, exploring alternative ways to reward oneself or enjoy leisure activities without spending money can help curb impulsive spending habits. Number 5, the saver. Unlike spenders, savers are highly cautious with their finances. They prioritize spending efficiently and are always looking for ways to reduce expenses. Savers are typically frugal and known for their ability to find cost-effective subscriptions and identify optimal times to make purchases at lower prices. They excel in budgeting and saving, traits that many admire. However, their cautious mindset can sometimes prevent savers from taking risks that could potentially grow their wealth. While saving diligently is commendable, some savers may become so afraid of financial loss that they hesitate to spend their savings on fulfilling hobbies or activities that could add joy and purpose to their lives. If you identify as a compulsive saver, finding a balance is essential. It's important to enjoy life while still managing finances sensibly. Allocate some of your money towards things that bring you joy, whether that's investing in hobbies, health, or education. Avoid making your budget overly restrictive. Allowing yourself moments of enjoyment and flexibility in spending habits is healthy. Feel free to adjust your budget as needed. Number 4, the balancer. These individuals strive to strike a perfect middle ground between different money personalities. They are cautious with their finances, making wise choices, yet they also allow themselves to indulge in things they enjoy spending on. Furthermore, they actively seek opportunities to grow their money, such as looking for investment opportunities. It might seem like balancers have found the best of both worlds, but maintaining this balance isn't always easy. They face challenges in navigating different temptations that pull them in opposite directions. For balancers, enjoying their money without guilt is important. They treat themselves occasionally to things that bring them joy or fulfill a need, all while staying open-minded about opportunities to increase their wealth. To stay balanced, it's crucial for balancers to be well-informed before making financial decisions. Seeking advice from trusted individuals is valuable, but trusting their instincts is equally important. Celebrating successes and taking pride in their hard work are essential components of finding happiness in both financial accomplishments and the effort put in. Balancers understand the importance of enjoying life while responsibly managing their finances, which allows them to maintain harmony between spending and saving goals. Number 3, the compulsive moneymaker. Individuals in this category tend to equate wealth with happiness, often believing that maximizing earnings is the key to fulfillment. They dedicate most of their energy to accumulating wealth and derive satisfaction from others' approval of their financial success. While compulsive moneymakers often make significant strides toward financial freedom, they can encounter challenges if they prioritize wealth accumulation over crucial relationships. For instance, they might choose to work excessively, including weekends, at the expense of spending quality time with loved ones. It's important for compulsive moneymakers to recognize that life encompasses more than just accumulating wealth. Even if they've amassed considerable financial resources, it's essential to give their wealth a purpose beyond personal gain. This could involve using their wealth to support meaningful causes or fulfilling long-awaited family experiences, such as taking a trip to Aspen or a tropical vacation they've been discussing for years. Achieving a balance between financial success and personal fulfillment is crucial for their overall well-being and happiness. Number 2, the gambler. Individuals with gambling tendencies often exhibit traits similar to those focused on making money and impulsive spenders. They derive pleasure from the thrill of risk and the potential for rewards, sometimes gambling simply to alleviate boredom. This excitement can lead them to experience unexpected wins or significant losses. However, the most critical risk arises when their gambling habits escalate to the point where they begin borrowing against essential savings, such as retirement funds or college funds for their children, to cover their losses. Breaking this habit requires reflection and discipline in assessing the financial risks they choose to take. To mitigate these risks, it's crucial for gamblers to strike a balance and prioritize financial security in their decisions. One effective strategy is to establish a habit of setting aside monthly savings before making major financial commitments. This practice not only builds a stronger financial foundation, but also minimizes potential risks associated with impulsive or high-risk financial behavior. Number 1, the investor. These individuals are financially savvy and conscientious about their money, actively seeking opportunities to maximize their assets regardless of their current financial situation. They are comfortable with taking calculated risks to increase their returns. Although it's important to recognize that this approach doesn't always guarantee success and can expose them to potential losses if their strategies don't pan out. For aspiring investors, diversification is crucial. Avoiding the pitfall of putting all funds into one investment and setting aside money for unforeseen circumstances are prudent steps. It's essential to carefully assess potential gains and losses in investments rather than relying solely on optimism. Moreover, investing exclusively in trusted assets and steering clear of enticing yet dubious promises of exceptionally high returns, which often turn out to be scams, is crucial. Understanding these habits that reflect your approach to money, whether you're an investor, saver, spender, or have other money personas, can significantly enhance your financial management skills. This awareness empowers you to curb impulsive spending, improve budgeting practices, make smarter investment decisions, and ultimately, secure a comfortable retirement. While completely changing your money habits may be challenging, acknowledging and understanding them is the first step in addressing any financial challenges they may pose. Successful financial management starts with self-awareness. Knowing your current financial position enables you to consciously adjust your actions, thereby increasing your likelihood of achieving both your financial and life goals.